Hello dear traders, I hope you're good. I wanted to make a video like this for a while, so I finally got the time to make it. What I'm showing here, I just made this table. So my intent is to compare those two different trading styles and markets. So on the one hand, on the right side, we see equity trading. Okay, so a stock portfolio, an active one, like long short strategies which are employed by big hedge funds and all that. Okay, and on the left side we see a portfolio of forex strategies, such as a bot portfolio with automated strategies, or like a portfolio of manual strategies based on the market causality. Okay, like different setups, the 4-hour reversals, the squeeze trades, and all these things. Okay, and I would like to compare the two in terms of risk and some other aspects. And I would like to emphasize certain points. And I'm always surprised that people do not realize these facts when it comes to those two major approaches to trading. Okay? So let's discuss some of them. So if you have an active stock portfolio, so let's say you pick a number of long positions and a number of short positions, and then like you have some kind of balanced portfolio, and every day you do some portfolio balancing. You may increase some positions and decrease other positions. Obviously you're all the time in the market. It's not that you are closing all the positions at the end of the day. So that implies, of course, that you have in the market risk, because things can always happen when you have an open position. Okay. Now, when we compare this to a forex spot portfolio, or like a collection of manual forex strategies, we are in the market when we have an open position. And as you know, for those approaches, if we're selective, the time you are in the market compared to an equity portfolio is, of course, low. Often trades take maybe a few hours or a few days. Sometimes they are very quick and just take a few minutes even. Okay, so that's one aspect I would like to emphasize. So the in the market exposure, so to speak, is lower for the forex portfolio. Therefore, also the average trade duration, is of course much lower, because if we have open trades and we close them, the time frame for those positions is much lower as compared to an equity portfolio. Now, another aspect which many people do not pay attention to: every day the stock markets open and close. So every day there is gap risk for any position you have and which you're holding. So that means, like, the market can gap against your positions, and suddenly it can lead to big drawdowns and other problems. We do not have that risk factor in Forex. We only have weekend gap risk, and that can be avoided if you close all your open positions on a Friday, which most of the time is very possible. That's a very important factor, because the gap risk is difficult to manage when it comes to equities. Okay? Now, index and trade correlation. So obviously, whatever you do in equities, there is always some kind of correlation to the overall index. Let's say you trade US stocks, there is some correlation of each title to the S&P 500, etc. Now, of course, by doing more advanced strategies such as long short, you can mitigate a lot of that as well. But you will be surprised how many stocks are actually correlated. Okay, it's like if there's a similar sector, they tend to have a high correlation. Of course, you may have like one company which particularly outperforms another. But speaking about a bigger sample, many people underestimate the high correlation between different stocks. And when it comes to Forex, we do not really have that. We had periods where, for example, there's a certain correlation between euro, dollar, and the S&P, but that is also subject to change, obviously, depending on the market structure in Forex, whether long is on the market or short is, etc. Transaction cost, again, here Forex wins again. The transaction costs are low compared to equities, okay, when it comes to commissions and, like stamp duties and all these things we have on the equity side. Forex is much cheaper to trade, so that's another plus. Slippage compared to at market orders in equities is also rather low. Stocks may be delisted, completely taken from the market and lead to a total loss. We do not have that risk in Forex. However, of course, whenever you do some active trading, there is some degree of black swan risk involved. Okay, that can mean that the broker goes under, yes, these kind of things. So there is some black swan risk with all active approaches. Trade frequency on the Forex side high compared to equities. If you have established a portfolio in equities after you did all the research, etc., you do not really exchange a position every day. You may balance the portfolio a bit, but the trade frequency is low compared to the Forex portfolio. Impact of fundamentals, it's very high for equities. In Forex, we know, again, it depends on the market causality first and foremost. If there are shorties in euro dollar, okay, the market will go up, even if sometimes the news would theoretically mean that euro dollar should go down. We've seen it many times. Regime switch sensitivity, so what I mean is, let's say suddenly the overall index goes into a bear market over several years, so we have a whole regime switch. That doesn't really exist in Forex. As you know, we have different market phases. We change from squeeze modes to 4-hour reversals, but that happens all the time. Number of instruments, well, it's high for the equities. There are thousands and thousands and thousands of different stocks around the world. We do not have thousands of currencies that are tradable right now. And if you take into account the correlation among currencies, let's say, for example, between euro dollar and Australian dollar, etc., then the number of instruments is definitely lower. Scalability, that is a minus of Forex. So when it comes to equities, we have big hedge funds trading billions and billions and billions of dollars and taking positions. I can tell you that for Forex, you can also trade massive accounts, but there are limits to scalability. Okay, you cannot have a 900 million account and do exactly the same strategy you would do with a 5 million account and do the same trades. That doesn't work. Why? Because, as I've shown, you get detected by the smart money, okay, and you will get pushed out of the market. Execution risks is higher for stocks. A lot of things can go wrong when it comes to execution of trades. That's not the same for Forex. And generally speaking, the win-loss ratio for a successful Forex portfolio will need to be high. Whereas on the equity side, if it's above 50%, they can often be overall net profitable. All right, risk-return expectations, generally speaking, so stock portfolios perform better if they have some really good hits, where positions run over and over into the same directions over months and sometimes years. Okay. Whereas for Forex it's a little bit more balanced. However, now let's talk about those important aspects here. Impact of market manipulation, as we know in Forex, is extremely high. The whole price mechanism is influenced by smart money, algo market manipulation. They go after positions, after stops, they fill orders, they fill option strikes, etc. So that's what you need to understand if you want to be successful in Forex. In stocks, we also have market manipulation, but it's conducted in a different way. We often have some fake orders in an order book, or they try to, appear as if there's interest for a stock. There's a whole set of other phenomena in this market, but the impact is not as high as compared to Forex. And here, this is the one thing which is important. That's why I put it in a different color. Strategy complexity, of course, for Forex is very high. When you compare what you need to understand from the market causality perspective, okay, or when you look at what you need to understand when you want to create automated strategies which are actually consistently profitable, the complexity is extremely high. And that's not the same for an equity portfolio. Even if it's long short, there's some fundamental analysis. They have a watch list. They pick stocks based on how the companies are doing, how the earnings were, whether there's a stock buyback, what they do with dividends, whether there's mergers and acquisitions, okay, whether, you know, there's some change in the industry and all that. So these are qualitative factors. Of course, they also take into account a lot of quantitative factors, ratios. Okay, they also do a lot of quantitative analysis, definitely. They analyze how, you know, net profits develop over time and all that, how the capital structures of a company, what the market cap is of a stock, all these kind of things. But in all fairness, even if you take this plus all kinds of technical analysis with indicators on the equity side, compared to Forex, you know, this is not as complex. Like by any standard, the complexity of analysis in Forex, as you can see from the market causality or from the complexity of any bot which is profitable in the long run, we are talking here about very, very complex analysis and implementation, I would say. Okay? So to summarize, when you look at this list, there are many, many advantages for Forex, okay? But what it comes down to is whether, first of all, you understand how the market mechanism works, okay? And that means causality, as we know. If you understand the causality, then you definitely have an edge, and that's not a big problem, okay? And then this is achievable. And when you compare that to equities, even when it comes to risk factors, such as gap risk and so on, an equity portfolio can actually be quite risky when you look at it from that perspective. However, the advantage of the equity portfolio is the scalability, okay? That's why we have big hedge funds trading these kind of strategies. All right, and while, you know, there are many disadvantages when it comes to things such as exposure and transaction costs and all these kind of things, the complexity of a strategy or analysis of selecting trades and all that is lower, because, you know, fundamental analysis still works, at least to some degree. Of course, you need to take into account other factors as well. However, you know, there is still, let's say, some fundamental causality in equities. If a company performs well and the earnings are great, you know, and everything is just moving to a positive result, eventually the stock will pick up, unless it was completely overvalued before and so on. However, there's also a correlation. There's also correlation to the index. Sometimes, you know, a company may do well, but the overall market is going down and dragging the stock price down, okay? So there are also other factors to consider. But in a nutshell, okay, here from a very general standpoint, these are factors which I do not see often discussed when it comes to this particular topic. And maybe this helps you to have a bit of structure in your mind when it comes to these kind of factors. Okay, so risk factors, as well as factors related to trading, as well as factors which are very relevant for you as a trader and investor. Alright, I hope you liked this video. I wish you all the best. Bye.